The way product costs move through the financials for merchandisers is that you start the beginning of the accounting period with a certain amount of inventory, and that's basically the balance from last year's balance sheet. Then they'll buy new inventory during the period, and that total is all the goods they had available to sell. Well, these dollars are going to either be left on the balance sheet as inventory, ending inventory, or they have been sold and have become an expense on the income statement. So you'll be asked to do some problems such as the following. So let's go through it together, where you're given a bunch of amounts, different line items. So let's go through. And our beginning inventory here we're told is 10,000. So going through knowing that that's our beginning balance, we'll put that there. Then what we need to proceed is we need to see what the purchases were on account. Again, the idea behind this is we're going to figure out the cost of the goods sold for the period. So we have purchases of 35,000. That's here, purchases, and it doesn't matter whether it was on account or paid. The point is that's how much they increased their inventory by during the period. So this company had $45,000 of goods available to sell. Now they can only be in one of two places. They're either still in inventory or they've been sold. Well, or stolen, but we won't go there. So we see here that the ending inventory is 12,000. That could be based also on a physical inventory count. When they figure out what they have left, then they know the rest has gone out the door and is your cost of goods sold. Now you could be given a problem where you weren't told what your ending inventory. Instead, let's go through a different one, slightly different, where you're told the cost of goods sold and not told what the ending inventory is. Well, you'd go through the same process. You've got your beginning inventory plus your goods purchased to get all the goods available to sell. And here we're told what our cost of goods sold are, so we know that if 33,000 have been sold, then there must be 12,000 left on the balance sheet as inventory.